Hello and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. And this episode is brought to you by moneymetals.com, the most trusted online bullion dealer and depository in the United States. Use Money Metals for purchasing, selling, or storing physical gold and silver. Hit the link in the description below to learn more and use coupon code JESSEDAY to get a $10 discount on your first purchase. Today's guest is a macroeconomist, investment strategist, and author whose latest book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better, is available now. Lyn Alden, it's great to have you on the show.
Happy to be here. Thanks for having me.
Yes, it's an honor to have you. I've been wanting to do this for quite some time now. And as you are a new guest on the show, I'd like to start with the origin story. So, how did you first discover investing, and how did that road lead you to where you are today?
So I actually started investing when I was a kid. First, it was gold and silver coins for savings. Basically, first was savings, and then by the time I was a teenager, I got into equity investing. Um, and I kind of like a not well off childhood in terms of financially. So I think from a young age, I developed a kind of interest in saving, building wealth, compounding. Um, and I eventually went to school for engineering rather than finance. And I worked in engineering for several years and then went into engineering management and more specifically running the finances and overall kind of guidance of an engineering facility. But I kept investing on the side and writing about investing and wanted to share about it. uh, Kind of the really good engineers when they go home from engineering, they keep engineering on something else in their spare time, whereas I didn't do that, and I would go home and just research something with financial markets or monetary history or something. And so I basically ended up pursuing that, and now I full time I do investment research. I also do some venture capital, and that's just how that's my story.
Well, when it comes to the state of the broad economy and markets at moment, I would like to start things off by talking about the issues facing the long duration Treasury market, which you actually wrote about in your latest newsletter. So we've seen the TLT 20 plus year Treasury bond ETF correct precipitously. We're seeing a lot of headlines and charts about how the current state of the long duration Treasury market is unprecedented. So could you break down what exactly is happening there and why investors should be paying attention?
So on one hand, it's return to normalcy. So instead of negative real rates, we're back up to a period of positive real rates based on many factors. The what makes it challenging though is that we're back at positive real rates with much higher debt to GDP ratios and very large deficits in the United States, and that's obviously a challenge. So we've had over the past 30 plus years, there's been a very strong disinflationary trend, globalization, China opening up to the world, followed the Soviet Union, Russia opening to the world. So Western capital, Eastern labor, gas from Russia, all this got kind of interconnected, very disinflationary. That allowed interest rates to keep coming down. But now, and that offset the constant debt to GDP appreciation. So if you double your debt but cut your interest rate in half, your interest expense is still manageable. But what we're seeing now is that things bounced off zero. Now that there's been more fiscal, there's been more inflation. There's less kind of the rate of globalization at the very least is slowed down, and in some areas it's outright reversed. And so now we have higher interest expense on a very, very high debt load. And so for the first time in a very long time, fiscal deficits matter. It affected, basically the UK last year. It resulted in a change of government in many, by the bond market. And now in the United States, we're seeing that just very large amounts of treasuries coming to market. So there's like a supply problem and a repricing. And I think it has long-term consequences. But in some aspects, it's a return to normalcy.
So I would like to also discuss something you talk about in your new book, Sound Money, and that is three eras of financial instability. You reference the international gold standard from 1871 to 1914, the Bretton Woods system from 1946 to 1971, and the dollar reserve system from 74 to present day. So, are there any parallels you could draw between those three time periods? And what do you think comes next for the financial system and the economy at large?
So a lot of it comes down to what the world is using as their settlement asset, their reserve asset, basically the world's money. In the older era, gold was the foundation. And then over time, a gold-backed dollar became the next foundation. And then in the modern era, the dollar itself became the foundation, partially linked to oil, but in general, just kind of the network effect. And so in any country, the state has the ability to kind of impose a currency on people up to a point, but in the international realm, you can't necessarily impose your currency on another area, and so state currencies compete in this global sense for network effects, liquidity, capital markets. If you hold those currencies and reserves, what are you going to reinvest it into? For example, is there a deep enough capital market, treasuries, equities, things like that? And so the dollar has this very strong network effect. And I think going forward, the dollar system is getting very stretched. And I think which way we go will depend on a couple key factors. One is that we could see a more multipolar world where you have the dollar on one side and you have the yuan and some of its adjacent currencies on the other side. That's challenging from a network effect standpoint. The other option, and possibly coincident with that, would be gold revaluation, basically central banks turning back more towards gold. And then also, technology now allows money to pierce borders more easily with things like Bitcoin, stable coins. So I think in many cases, countries are going to have a harder time imposing their own little currency bubble on their people because there's more, if like I could send you money over this video call with a QR code, it's that peer to peer now, and that would work for almost any market that has basically an internet connection. And so now it's I think the rise of digital assets, especially neutral open source ones, are yet another challenge. So I think that really the direction of digital assets will affect this because I think they are really taking off, and these other ones are kind of these more analog things that are kind of like the fallback methods, or it's what the powers that be would prefer. And so it's we're kind of watching the Game of Thrones of money right now, which is a couple leading network effects kind of coming to a head in the years and decades ahead.
Yeah, very fascinating. And I do want to touch on Bitcoin in a little bit. But first, I would like to get your thoughts on the commodities sector broadly as a whole. Are we on the precipice of a commodity super cycle, in your opinion, as many are alluding to?
So I generally don't like the word super cycle, but I do think we're in a commodity bull market. I don't really know how to define a bull market versus super cycle, so I just call them bull markets. But it's basically tied to the capex cycle. You have a period of rapid capital expenditure, new sources of energy, new deposits all coming online, and eventually you flood the market with too much. You have some sort of economic slowdown, which hurts demand. Then you kind of enter this long period of oversupply, cheap prices, lack of capex. And going forward, I think that that's turning, and it's really been turning since kind of the pandemic bottoms. And so I do think that we're likely in a multi-year, ups and downs, but a longer term commodity bull market until the prices go up enough that enough new capex comes online and starts the next cycle. So yes, I'm broadly bullish on commodities with different time frames, generally long term, especially centered around energy.
And the counter argument to that is often we're going to be entering a recession, a global recession that is going to bring on demand destruction, that is going to curb demand for all these commodities. What would you say to that argument? Is the supply side simply that restrained from years of underinvestment and other factors that even a recession wouldn't mean lower commodity prices necessarily?
So part of it's the supply side. And so, for example, in the dot-com bubble recession, so right after the dot-com bubble, early 2000s, it's not like commodities got killed in that cycle. They just kind of chopped along for a period and then resumed the bull market in the next cycle. So it's not, we during the global financial crisis and then again during the COVID crisis, that's the recency bias that we associate recessions with just commodities get killed. And whereas that actually does not happen in every recession. That happens in some recessions, partially tied to the capex cycle and other factors. The other factor would be the fiscal side. So basically, the way that the Western kind of sovereign debt situation has unfolded, as you bring debt from the private sector up to the public sector, which is the rotation we've seen in recent years, that makes it a lot harder to sustain a recession in this in kind of real terms because um, when that happens, tax revenues fall, and we're already running in the U.S. $1.7 trillion deficits. So we're already pre-stimulating, and so I think basically it's we have to go back to the 1940s to find a similar macro environment. That's something I've been kind of pointing out for the past 3, 4 years. And so I think that while there is a risk of demand destruction, slowdowns, things like that, and for example, I've been cyclically not super interested in copper for the past couple of years because of that reason. I was like, okay, I'm bullish long term, but I think we're having a slowdown for a period. Maybe that's ending now. I'm not sure. I've been more bullish on energy, so I do think we have to be somewhat cyclically aware of the risks. But I also think we shouldn't overly focused on the past two recessions with recency bias, and the combination of the capex cycle and the sovereign debt situation, the fiscal deficits, are, I think, overall bullish.
Well, let's hone in on gold specifically here. We've seen a run up recently, perhaps partially in response to the Israel Hamas conflict, but the long term fundamentals look very solid. You mentioned central banks potentially evaluating gold, revaluing it. They are accumulating gold at record levels, as has been pointed out by so many people, obviously. But I wonder what your thoughts are for the long term outlook for gold and why you think central banks have been accumulating it at such an aggressive pace.
Well, so I think a lot of countries are realizing that they don't want their sovereign savings to be freezable by another country. And so self-custodial assets are really the only way to do that. And gold is the densest way to store value in the physical realm. And so it's there's been a if you look at a chart of BRICS and BRICS allies gold holdings over the past couple decades, they've gradually risen and caught up with U.S. official gold reserves. At the same time as you've seen kind of flat foreign treasury exposure over the past 10 years or so. There's just been not a lot of accumulation, especially compared to how much has been issued, how much treasury issuance has come to market. So the foreign percentage ownings of treasury keeps going down, and I think it's because we're exiting the period of unipolar power. The US is the hyperpower. Everybody just kind of putting all of their eggs in one basket of the US. I think we're seeing more um, kind of decentralization in that regard. And I think, Russia was kind of the bellwether for that. Um, they had already largely de-dollarized around with their reserves. But they got, I think, caught off guard by the euro area freezing their euro reserves. So basically, U.S. and allied, pools of capital are now less attractive, I think, to a number of BRICS type countries. And I think we're basically just we're seeing more of that shift. And with gold, it's held up very well despite the sharp rise in real rates, in large part because I think there's a good amount of sovereign buying. And so I think in the years ahead, it's likely to have a decent breakout. Among the younger investors, or even just increasingly some institutional investors that has to compete with Bitcoin now. So there's like a fracturing of what people were used as was as hard money. So that's kind of a headwind against it. I think it would be higher today if say Bitcoin was never invented, if that technology was not ready yet. So now, but I think those two together are in the process of kind of taking market share back from the very centralized dollar system.
And do you view silver in the same way as gold? Do you think it's taken on more of an industrial role as opposed to being a monetary metal? And are the supply demand fundamentals for silver on the industrial side currently favorable in your view?
So most commodities tend to move together. Not all of them, but in general, when you have a structural, commodity bull market, it's usually because the dollar is weakening, and it's because the commodities are going up in value. So a lot of these things tend to move together. So I just kind of by extension, I'm bullish on silver. It has a number of industrial applications. It still has some degree of monetary premium. Ever since the dawn of the telegraph, the silver's lost a big chunk of its monetary premium, and what I mean by that is the gold to silver range of trading was pretty much between 10 and 20 for like thousands of years. And ever since the dawn of the telegraph, where we relied less on silver's divisibility for money. So basically, for eons, gold was like the money for merchants and monarchs, and silver was money for the people. But when we start using banknotes and bank accounts and things like that, and we started abstracting gold, people kind of dropped silver, and so silver got left behind. And in this current environment, we see central banks are stacking gold, not silver. That's where big pools of capital go because you get a lot more value dense, for what you're doing. And so I think that silver is likely to come along for the ride, and it has its own supply demand characteristics. But I'm broadly bullish on most large commodities.
And I've heard you discuss the energy sector many times in the past. I know you hold some energy stocks in your newsletter multi asset model portfolio, which you provide to newsletter subscribers. Do you view the oil and gas sector as, some people point to it as being very volatile, very influenced by geopolitics? Or could it actually provide a safe haven in the current investing landscape, particularly with the price of energy rising, the price of gasoline rising, diesel, all of these things? Could it be a hedge in that sense?
I think that's a good way to describe it. That within the context of an overall portfolio, it's a defensive action, even though as its own slice, it can be quite volatile. You have geopolitical risk can happen in the sense that countries, they can do windfall tax profits like on it. There's all sorts of things you have to pay attention to supply demand characteristics of the industry. The bullish thesis could be wrong about the supply side, the demand side. There's a number of risk factors that can threaten the bull market, but I would say the combination of producers have pretty low valuations. A lot of them have decent balance sheets now. They're not reinvesting a lot heavily into capex. They're just kind of returning value to shareholders and maintaining their capex. Obviously, some are growing, some are not. But as an industry, it's not super aggressive. And then also the commodities themselves offer, I think, some good long-term holding periods. Um, and the way to think about it is that the past 30, 40 years of disinflation, stocks and bonds were the big inverse correlation trade. But in more inflationary environments, they tend to have more positive correlation. Higher bond yields put, say, valuation pressure on equities. Like if you can get 6% on a 10-year at some point, maybe you don't want to buy the 30 price to earnings, medium growing equity, right? You say I'll wait till it goes down to 20 price to earnings, 5% earnings yield. Um, and so in that environment, um, bonds kind of are less useful for that purpose, or at least long duration bonds. And I think that energy and commodities become the hedge because when you think of what can disrupt your equity portfolio, well, inflation spikes, material shortages, things like that. And so you want to own some of those to offset some of your assets that prefer disinflation in order. So equities prefer disinflation in order, whereas commodities and a couple other industries kind of prefer inflation and chaos for lack of a better. And so if you have a little bit of both in your portfolio, they can work well together in this specific type of environment.
I want to get your thoughts on jurisdictional risk as it relates to the energy sector, but maybe also across the commodity spectrum in the mining space as well. How do you mitigate jurisdictional risk? Obviously, we see events transpire like the coup in Niger, which affected a lot of uranium companies there. But at the same time, you were mentioning windfall taxes. Some other countries might implement those sorts of measures. We saw Mexico put restrictions on open pit mining. Canada, obviously a great jurisdiction for oil and gas, but the Liberal government is very anti fossil fuels. So who knows ultimately how that will turn out. Do you stay geographically diversified to mitigate jurisdictional risk? Do you stick to royalty and streaming or ETFs? How do you approach that?
So my main strategy is the diversification. I use ETFs and individual stocks, but because I focus on the usually the bigger picture, basically there's two ways to do this. Either someone could, if they're an expert in that field and they want to spend all the time on individual stock analysis, jurisdiction analysis, they can go pick out the best jurisdictions and spread into those. The other option is to say, with some common sense principles, I'm just going to diversify across the board. Maybe with an ETF, like iShares has a global ETF, so not just the US producers, but global producers and some pipelines in there too. Or you can just pick a bunch of different majors and mid cap kind of energy producers individually. But either way, I do think that you want to spread your eggs around a little bit because as we saw in the prior price spike, some jurisdictions were quick to jump on that. A lot of it is because some of their own policies have slowed down capex. And so if their own policies come back to haunt them, they need someone to blame, and you blame the energy producers if oil goes up to 150 a barrel or something, if gasoline prices are soaring. they need someone to blame, and so that's the risk, especially as sovereign governments have very large debts and deficits, especially in some countries. That is a risk to worry about. So you can diversify by owning multiple producers. You can diversify by owning the commodity itself in some cases. You can diversify by owning some service companies that might service the energy producers, but might be not targeted by windfall, approaches themselves. I just think you have to kind of just spread out a little bit because you could have an otherwise great trade get kind of taken away from you, and you have to just I think be careful of that.
Yeah, that makes a lot of sense. I would like to dive a little bit further into your multi-asset model portfolio, which, as I mentioned, you provide to free newsletter subscribers. You have it divided into dividend stocks, growth stocks, international ETFs, and commodity producers. Could you give us some insight into how you constructed this portfolio and why it is, as you put it, your best representation of where you think value is in the market?
Sure. So the classic 60/40 portfolio, as I said, has a number of limitations in a more inflationary environment. So my thesis for several years is that we're in a more structurally inflationary environment. That doesn't mean we always have 9% inflation. Inflation go up and down, but that average, the higher highs and the higher lows compared to the inflation of the past decade. And in that environment, a 60/40 portfolio has not been good. Um, and so instead, I generally say, okay, well, there's still a number of high quality equities, sometimes value equities, sometimes growth equities, globally and in the US. There's plenty of good ones. You can buy those and let them compound for years. But at the same time, for the other part of your portfolio, if you're trying to reduce volatility or protect those equities, bonds are not the best way to do it, at least not at size. And so I said, well, okay, let's put some of it into shorter duration bonds. Let's put some of it into gold. Let's put some of it into commodity producers, as I talked about. That can be a hedge against things that otherwise prefer disinflation and order. And so and I have a Bitcoin slice in the portfolios. And so basically it's a way to say, okay, well, this is a very unusual macro environment. We have to go back to the 1940s to find a similar one. And but there's always curveballs. We don't know what might or might not happen in terms of geopolitics, what might or might not happen in terms of rule changes, how the timeline with which this commodity bull market is going to happen on, if we're correct about that. And so it's okay, let's diversify, but not just fall into the trap of having that kind of 60/40 disinflationary portfolio. And so that's how I construct that and how I go about that.
So I want to discuss Bitcoin with you here, which I'm very excited to do because I'm overweight Bitcoin myself. It's the first thing I ever invested in, and I rarely get to discuss it because most of the people I speak with are hardcore gold and silver bugs, and they think it's magic money, and they've done zero research into it, and so it would be a fruitless conversation. So I'm very excited to get your views on it, and I want to do it by touching on this tweet you recently made where you said, I don't think people realize the power of this ecosystem. It's a new money, it's a revival of Austrian economics, it's a tech religion, it's a peace movement, etc. It's a tool that empowers many things, each of which are powerful, unless someone can break it. The big question. So, firstly, how can Bitcoin emerge as money if it hasn't been adopted at large scale yet? How far into the future do you think we are away from a more mass adoption that would actually allow it to be used for regular transactions? And how could someone potentially break it?
So Bitcoin and money in general, money is a network effect good, meaning that the more people use it, the more useful it is. Kind of like a social network. If someone builds a social network with a really great user experience, but there's like 8 people there, it's just a terrible social network. Uh, Whatever one can gather the users is just better for every individual user, and the same is true for money. Money tends to, it's the most liquid, divisible, widely accepted thing around. And so that takes time, and basically there's a bootstrapping phase that's different from the long-term adoption phase. So right now, Bitcoin's kind of killer app is really two of them. So one is portable scarce savings. So it's a global ledger. It's decentralized. Anywhere in the world with an internet connection, you can bring your Bitcoin with you globally by memorizing 12 words representing your seed phrase. You can't do that with your gold or your physical cash, for example, at size. It can be used to pay people internationally. The other kind of killer app is that if you get deplatformed from other payment methods, or your country gets deplatformed from the world payment methods, or you're in an environment that's just more authoritarian, so people are getting debanked all the time. Basically, whenever you find yourself censored in terms of payments, this is now a technology that empowers people to go around them. The first use case was WikiLeaks getting deplatformed and started turning to Bitcoin donations back, literally over a decade ago, and that's still a trend. Now, at the current time, it's volatile, it's new, it's being explored. It's maturing, but it's still new. And what I would say is that when we look at global saleability, so in any one country, Bitcoin does not have a lot of like use case compared to the local currency. But if you rank the bare assets you could bring with you globally, it'd actually be towards the top. So dollars and gold coins would be like at the top. And if you think, okay, what else can I bring with me globally that I could find a buyer with, not that much friction. So probably euros would be next. Silver coins would be up there. There's a number of little kind of bare assets you could bring with you. But out of the 160 plus currencies in the world, Bitcoin's probably in the top 10. I mean, it's easier for me to find a buyer or seller of Bitcoin in most countries than, say, Egyptian pounds, like Canadian dollars. Basically, when you have a currency outside of its own jurisdiction, the saleability falls off a cliff. And Bitcoin is not super saleable in any country, but its baseline level of saleability is actually not bad, and the trend is structurally up. Now, as for breaking it, I mean, this is still a technology at the end of the day. It's very robust. Um, it, we China banned it several times, which, if China has trouble banning it, that's a good sign. But they banned Bitcoin mining in 2021, and that time it stuck more. They went more after it. And the half the network literally went offline, so half the miners went offline very quickly. And if we imagine you told Amazon or Microsoft, hey, next week you have to shut off half your servers and move them internationally, what would the downtime be for a lot of their services? It'd be catastrophic for them. It would take them months, maybe a year to get fully back online. Whereas Bitcoin, half the network goes offline in a week. It slows down for a week, but it's still fully usable, 100% uptime. Then the difficulty adjustment automatically kicks in, goes back to normal, and those miners kind of reassemble themselves in other jurisdictions like a swarm, just kind of moving out of the way of friction. It's a very robust system. But there's challenges, there's frictions, there's uncertainties. There's always risks of the government bans. Some countries do try to ban it or make it harder to get. And so I think it still has challenges to go through as it's competing with very large network effects. But it's already serving a purpose, and it's just kind of saying if no one could find a way to break this momentum in terms of adoption, scarcity, liquidity, and the tech working, then I think it continues to gain market share.
Well, thank you so much for joining us today, Lyn. It's been a very enlightening conversation. For those who want to learn more, can you tell us about your new book, Sound Money, your newsletter, and anywhere else you'd like to direct people online?
Sure, the book's called Broken Money. It's available on Amazon and some other places you can buy it. And what it does is it explores money from its origins. So where did money come from? What are the different schools of thought on money, and how do they conflict, or how do they agree? The development of banking. And what I do differently than some other money books is I look at through the lens of technology. So how did new technologies change what monies we use or what banking arrangements we use, all up to the modern day of digital assets. So Bitcoin, stable coins, central bank digital currencies, some other kind of blockchain explorations. I explore that whole kind of gamut to educate the reader and try to give them a very deep understanding of money. I also do work at lynalden.com. That's my research portal, so people can check that out.
Great. I'll put links to those below as well as to your Twitter. I recommend people follow you there. And thanks once again, Lyn, for coming on and sharing your knowledge with the audience.
Thank you.
And thank you for joining us today. As a reminder, this episode is sponsored by moneymetals.com. Use coupon code JesseDay to get $10 off your first purchase. Link is in the description below, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.